I want to jump into some basic terminology to lead with your numbers, okay? And what prompts this is back listening to Bill's quote or his question. He gets to the place where he's asking the question and there's this frustration and you can hear it in his voice. And he says, ultimately in the end, you know how important it is to, consider doing things like building up, trying to own some assets or something. And then he says, is it just cash flow that needs to be a priority, or is it cash flow versus financials and building those up? Okay. First of all, I want to thank Bill for these questions and his honesty, because I think there's a lot of entrepreneurs like Bill out there who have been in business quite a while, probably similar to Bill, never had really great accounting support and really gotten really bad advice about all of that stuff. So I'm here to help correct that and help you guys. So I welcome your questions. You can leave comments here, go to my website, and even Let's Talk. There's a Let's Talk button where we can chat. So let's jump into this and let me clear some things up. So when Bill is asking about cash flow versus financials and building them up, remember the mirror analogy from the last video where the financials are the company. So it's building up the company. And what I want to help you guys with here is understanding your numbers. And what I've come to find out in talking to you all is that, or not you all directly, but others, is that the term financials is intimidating to most entrepreneurs simply because we don't know what it all means and what it all is. I got to use some financial terminology and I got to get us on the same page. And I think this is going to help, okay? So I want to make this really, really simple, explain some things, break it down, and that's going to help us as we go forward in this series. All right, so some basic terminology. When Bill talks about financials, basically there's 4 major kinds of financial reports or statements, okay? And it's the balance sheet, it's the profit and loss statement, called oftentimes referred to as simply the P&L, statement of cash flows, and then statement and changes of financial positions. Now, as finance people, we love all the other geeky stuff, so there's lots of ratios. You could even say budgets are a financial, projections, modeling. I like to do a lot of modeling. So all of these things are financial, but essentially, and you probably have not even heard of the last 2. Doesn't matter, okay? I just want you to know, when you use the phrase financials, that's what that's talking about, okay? Now, let me break these down just a little bit, and we'll start with the P&L. And you'll see here some terminology, and I'm just going to go through it. This is organized in the way the P&L is actually organized, all right? So you have revenue or gross sales. Those terms are used interchangeably. It's okay. You have a section called cost of goods sold. And the cost of goods sold is anything that directly contributes to the generating of the revenue. So or the making of the revenue. Like if it's manufacturing, you're going to have goods and labor. Okay, so you bought some raw materials and labor. If you're retail, it's going to be you bought goods, you're selling them. Okay, if you're a service business, it's just going to be cost of labor more than likely. Okay, now it's not things like marketing, because that would go down in the expenses. So those are all there, because marketing is promoting everything. Okay, it's not promoting one particular product or service or anything like that. So you don't try to allocate that. It just goes down into what expenses are essentially non-direct expenses. And then you subtract expenses from gross profit. Oh, and I should go into that. So gross profit is revenue less cost of goods, and the term gross margin that a lot of people use is simply the percent. Okay. So it's the percent of gross profit to gross sales. And then you subtract out expenses and you end up with net income, net profit, bottom line. Any of those terms are fine, okay? When I'm using the term profit, I'm talking the net. I'm talking the bottom line, okay? Gross profit, I would say gross profit. All right. And then there's the balance sheet. Now, I got to be honest. I studied finance, I've done finance, and it was years before, maybe even probably 10, 12, 15 years, I don't know how long, a long time before I really understood the power of how to use the balance sheet. No one ever showed me. So I can't even imagine what it's like for entrepreneurs out there. And so my experience with business owners is they don't even know what it is. They don't even look at it. They don't pay any attention to it. Yet they use elements of it all the time, as you're going to see. So, one of the things I'm all about is bringing you great advice, super good guidance, and clarity on these sorts of things. And so stay tuned, and we're going to get into some of this, and we'll keep providing more content around this because I've been doing this for years for folks. So we start the balance sheet off with the assets. All right. And assets are things like cash, accounts receivable. That's what you've invoiced people and they owe you. There's fixed assets like building, equipment, land, things like that. There's other assets. They could be prepaids. They could be like your security deposit for your rent or something like that. You'll notice the assets. And if you get one thing from this, get this. Notice how it's organized with the most liquid assets on the top and the least liquid assets on the bottom. Okay. So cash is the most liquid thing you've got because you can go right out and spend it. A receivable, well, I could borrow against the receivable. So that's kind of liquid, but they owe me in 30 days, so I don't have it for 30 days, but in 30 days it will be, closer to liquid. Once I get the cash, it's liquid, okay? The chances of me going out and selling the building or a piece of equipment, that's very illiquid, okay? And we're not even sure what the value of that would necessarily be. All right, so then the next section is liabilities. And these are the negatives, okay? So liabilities are things like accounts payable. That's when you owe vendors directly. You might put it on the credit card. So credit cards would fall in that category. Debt. There's short-term debt and there's long-term debt. Like your credit line would be short-term debt. Term debt is usually long-term. It's over a year is long-term. And then other liabilities, there's a whole bunch of things that could fall into that category like customer deposits, payroll taxes, all that kind of stuff. All right. You'll notice the liabilities are organized from the most current liability to the most long-term liability. And you take the assets, you subtract the liabilities, and you end up with the equity or net worth section of the balance sheet. And things in that are going to be your stock or capital account. You've got retained earnings. So retained earnings is the accumulated net income over the life of the company. And sometimes just depending, I call it net income here because you also have your current period net income will be reflected on your balance sheet typically. So that's a quick tour. If you would like a copy of these slides, just a little orienting, happy to provide that for you in a PDF form. Just click the link below, go to LiveTrulyFree/slides, and there'll be a way for you to get these so we can email them to you. So, hope this gives you some orientation. And next we're going to jump into actually using these terms and seeing what that's all about. So, if you've got questions, comments, please leave them below, and we'll see you in the next video tomorrow.